Iran is now charging a toll on the most important oil choke point on Earth. Not in theory. As of Friday, there is an agreement on the table. Tehran collects a fee on cargo moving through the Strait of Hormuz, and American ships are barred from the water entirely. Here's the shape of it. First, what Iran and Oman actually agreed. Second, what oil and the markets did the moment they heard it. And third, the question nobody in Washington wants to answer out loud: who actually ends up paying this toll? Stay for that last one, because the answer sits closer to your gas tank than you think. First, the deal. On Friday, Iran announced it had reached an understanding with Oman on a shipping route through the Strait of Hormuz. Listen to the fine print, because the fine print is the story. It is a temporary route, 2 to 4 months. It runs through Iranian territorial waters. Iran's deputy foreign minister said, in his own words, "This understanding does not mean the full reopening of the Strait of Hormuz, and it is conditioned on what Tehran calls a change in American behavior." Now here is the part that did not make the headlines. According to reporting sourced to the negotiations, the concession on some form of Iranian control over Hormuz has already been made. Iran is asking for a fee of 5 to 7% of cargo value on ships moving through. Oman has countered near 3%, and under the proposed terms, American and Israeli vessels do not transit at all. One analyst at Eurasia Group put the endgame plainly: Washington accepting Iranian control of the strait without ever explicitly acknowledging that control. Think about what that means. Months of American and Israeli strikes did not remove Iran's grip on the waterway, so the strikes stopped and the negotiation moved to the price of passage. The White House, as of this recording, has not responded to the announcement. Second, the market's verdict. You would expect a superpower losing control of an oil choke point to send crude vertical. The opposite happened. Brent crude fell toward $79 a barrel, West Texas near 75, after losing roughly 11% across the first 3 sessions of the week. Because for the oil market, a taxed strait beats a closed strait. Bottled up Gulf barrels start moving again, even if every barrel now carries an Iranian surcharge. Stocks liked it too, though they were watching something else on Friday, the jobs report. The American economy was expected to add around 80,000 jobs in July. Instead, it lost 23,000. Unemployment sits at 4.1%. Bad news for workers, good news for markets, because a shrinking labor market takes the pressure off the Federal Reserve to keep raising rates. Futures now put the odds of a September pause near 56%. The S&P 500 rose to a record close near 7,758, its strongest week since April. The Nasdaq gained 1.3%. The 10-year Treasury yield slipped to 4.64. Gold jumped. The dollar weakened. Read that tape again slowly. Jobs falling, gold rising, and a foreign power taxing the world's oil artery, and the index prints a record high. That is not a healthy market. That is a market betting the Fed blinks first. Third, who pays the toll? Here's the payoff. A percentage fee on cargo value does not come out of Tehran's pocket, and it does not come out of the shipper's goodwill. It gets passed down the chain. Tanker owners fold it into freight rates. Insurers price the risk of an Iranian-controlled lane. Refiners pay more for the barrel, and you pay for all of it at the pump and in every product that moves by sea. A toll on Hormuz is a private tax on global energy, collected by a state the United States is technically still confronting. And there is a second cost, slower and bigger. The Gulf states are not waiting around. They are accelerating pipelines that route around the strait entirely. That is billions in new infrastructure spending whose only purpose is to escape a choke point that used to be guarded for free by the American Navy. Protection of sea lanes was the quiet subsidy underneath globalization. That subsidy is being repriced in front of you. None of this is financial advice. It is a map of who holds the leverage, so you can see the next move before it hits your cost of living. So here's the question I keep turning over. If a blockade can be converted into a business model, and the strongest navy on earth ends up negotiating the fee schedule, what does that say about whose rules the next decade runs on? Tell me what you think in the comments, and I mean actually argue it, because I read them. Blue pill. This is a temporary arrangement. 2 to 4 months. Oil is cheaper, ships are moving. take the win. Red pill. The concession is the precedent, and every choke point from Suez to Malacca just watched a toll booth get approved. Neither of those is stupid. Pick your side and defend it. We drop 3 briefs a day on this channel. Macro at 7, crypto at 9, and AI at 11 Eastern Time. So the next one is only 2 hours away. The timeline keeps moving. We will see you in the next one.